Assalamu alaikum. Welcome to my video presentation. This is Mohammad Rezwanul Haq and my student ID NONG is 20108371444. I am pursuing a one-year MBA program in University of Rajshahi and currently enrolled in second semester in Department of Banking and Insurance. Today I am going to talk about exchange rate system of Bangladesh, including its evaluation mechanism and policy implications. So these are the key topics that we'll cover in today's presentation session. Why exchange rates matter? The exchange rate is a key macroeconomic pillar that influences inflation, trade competitiveness, and the balance of payments. For Bangladesh, managing the exchange rate is a delicate balancing act. It must keep exports, especially the RMG sector, competitive while controlling the rising cost of imports like fuel, food, and machinery. At the same time, it needs to sustain strong remittance inflows, a major source of foreign currency, and maintain adequate foreign exchange reserves. As of May 21, 2026, the interbank exchange rate stands at BDT 122.75 per USD, with the Taka depreciating by about 44.8% since 2021. With Bangladesh graduation from least developed countries status in 2026, pressure is increasing for a more flexible exchange rate system. Historical evolution of exchange rate regimes in Bangladesh. Bangladesh exchange rate system has gradually shifted from strict control to greater flexibility. From 1972 to 1979, the country followed a fixed peg, first to Great Britain pound, then United States dollar, which ensured stability but led to overvaluation, hurting exports like jute and encouraging imports. Between 1980 to 2002, it adopted a basket peg based on major trading currencies. This allowed some flexibility with periodic devaluations that supported the growth of the RMG sector. From 2003 to 2012, Bangladesh moved to a managed floating or crawling peg system, adjusting rates gradually based on inflation and balance of payments, making the system more market driven. Since 2013, it has maintained a managed float with active central bank intervention to control volatility and protect reserves. So in conclusion, the system has evolved from rigid control to partial market determination. Current mechanism: managed float in Bangladesh. Officially, Bangladesh follows a managed floating exchange rate under International Monetary Fund classification. In practice, however, it operates a unified interbank market with strong central bank intervention. As of May 21, 2026, the United States dollar per Bangladeshi Taka rate is 122.75, identical for bid, ask, and the weighted average rate. A key observation is the zero spread between bid and ask rates. This indicates that the market is not freely determined. Instead, the central bank effectively acts as the main counterparty, setting the daily reference rate and tightly controlling exchange rate movements. Cross-rate analysis: major currencies. Cross-rate spreads reveal liquidity and cost dynamics in Bangladesh's forex market. The Great Britain pound shows the widest spread, 8.59 pips, indicating low liquidity and higher transaction costs, making United Kingdom remittances particularly valuable. The euro has a moderate spread, 2.46, suggesting European exports remain competitive, but imports like machinery are relatively expensive. In contrast, Japanese yen and Indian rupee have extremely tight spread, 0.02 and 0.03, reflecting high liquidity. However, the Taka has depreciated significantly against the Indian rupee, making Indian imports more costly. The Chinese yuan spread 0.58 aligns with global benchmarks, implying consistency with international markets. Focus on Indian rupee per Bangladeshi Taka regional competitiveness. Currently, 1 Indian rupee equals about 1.2828 Bangladeshi Taka, showing a clear depreciation of the Taka over time. Earlier, it was around 1.15 to 1.20 during 2010 to 2015 and nearly parity 1.00 in 2021. This shift has mixed effects. On the positive side, Bangladeshi exports become cheaper for Indian buyers and remittances from India gain more value. However, the downside is significant. Indian imports, which make up roughly 15% of total imports, have become much more expensive. From a political economy perspective, the Indian rupee is not fully convertible, and most transactions occur through straight settlement mechanisms like the Asian Clearing Union. Factors influencing the Bangladeshi Taka exchange rate. Several key factors drive movements in the Bangladeshi Taka. First, the inflation differential puts downward pressure on the Bangladeshi Taka. Bangladesh inflation around 9 to 10% is higher than the United States, 3 to 4%, weakening purchasing power. Second, the trade deficit consistently around $20 to 25 billion raises demand for United States dollar to finance imports, causing depreciation. On the positive side, remittance inflows of $20 to 22 billion annually support the Taka by supplying foreign currency. However, any slowdown quickly adds pressure. Foreign exchange reserves have dropped sharply from $48 billion in 2021 to about $80 to 20 billion in 2026, reducing the central bank's ability to stabilize the currency. Finally, interest rate differences have a limited effect. While higher rates could attract capital, strict capital controls restrict inflows. Recent challenges and volatility in Bangladeshi Taka. The Bangladeshi Taka has faced steady depreciation, falling from 84.8 per United States dollar in 2021 to 122.75 by May 2026, a total decline of almost 45%. This trend reflects several key challenges. First, foreign exchange reserves have dropped sharply to around $80 to 20 billion, covering only 3 to 3.5 months of imports, well below the 6-month safety benchmark. Second, regional pressure is rising, with the Taka depreciating about 28% against the Indian rupee since 2021, making imports from India more expensive. Third, Bangladesh's graduation from least developed country status in 2026 means losing preferential trade benefits. So, competitiveness now depends more on the real effective exchange rate. Finally, cross-rate illiquidity seen in wide spreads for currencies like Great Britain pound signals reliance on United States dollar and concentration risk. Comparative analysis: Bangladesh versus India versus Vietnam. Bangladesh follows a de facto crawling peg with moderate to high volatility, 6 to 8% depreciation, lower reserves approximately 3.5 months, and restricted capital flows. Its policy relies heavily on direct intervention and multiple exchange rates, which can create arbitrage opportunities. India, in contrast, operates a managed float with inflation targeting. It experiences low volatility, 2 to 3%, maintains strong reserves approximately 10 months, and uses transparent tools like interest rate adjustments and forward swaps, building greater market credibility. Vietnam uses a crawling peg within a United States dollar band with moderate volatility, 4 to 5%, and reserves similar to Bangladesh. Its active band management combined with export diversification supports stability. So in conclusion, India's transparency strengthens trust. Vietnam shows discipline, crawling pegs can work, while Bangladesh faces challenges from lower reserves and multiple exchange rates. Policy recommendations. First, allow a small positive United States dollar per Bangladeshi Taka spread 0.10 to 0.25 to revive interbank trading and restore price discovery. Second, improve cross-rate liquidity by encouraging banks to quote competitive two-way prices, especially for currencies like Great Britain pound and Australian dollar. Third, widen the exchange rate band to around plus or minus 2 to 3% to absorb shocks and reduce pressure on reserves. On the monetary side, continued tight policy, keeping or raising the repo rate approximately 10.5% to control inflation. Regionally, gradually realign the Indian rupee per Bangladeshi Taka rate around 1.32 to 1.35 to maintain competitiveness. Also, increase transparency by publishing daily intervention data to build market confidence. Finally, hedge exposure to yen-denominated debt to manage exchange rate risk. Concluding remarks. Bangladesh exchange rate system is currently at a critical transition point. The previous approach of maintaining artificial stability through heavy intervention is becoming unsustainable, especially after global shocks and the country's least developed country graduation. As of May 21st, 2026, the United States dollar per Bangladeshi Taka rate stands at 122.75 with a zero bid-ask spread, indicating a heavily managed rather than market-driven system. Significant depreciation against the Indian rupee and wide spreads in other currencies also reflect both external pressures and internal imbalances. Moving forward, Bangladesh needs to shift from defensive management toward a more flexible, transparent, and rule-based exchange rate framework. References. This analysis is based on credible international and national sources. Key data and policy insights are drawn from the Bangladesh Bank, including annual reports, monetary policy statements, and foreign exchange guidelines. International assessments are incorporated from the International Monetary Fund Article 4 consultation reports and the World Bank's World Development Indicators and Bangladesh Development Update. Theoretical and analytical frameworks are supported by International Financial Management Madura 2020. Additional academic perspectives are drawn from peer-reviewed research in journals such as the Journal of Asian Economics and Bangladesh Development Studies. So that's end of my presentation. Thanks for watching.